So in our last class, we started with operating statement, and I mentioned to you that the operating statement, which is the same thing as income statement, is a statement prepared. Is a statement prepared to present the operating performance of an organization for a specified period. Okay, it could be on a monthly basis, it could be quarterly, biannual, or annually. However, I also mentioned that there are two specific methods that can be used to present income statement. One is marginal costing concept, then two, absorption costing concept. I started with the marginal costing concept, saying that marginal costing approach is a technique that charge the total variable cost of production to the unit cost of a product, including the direct material, direct labor, direct expenses, and variable overhead. So when you want to determine the unit cost of a product, only the direct cost or marginal cost or variable cost of production will be charged to the unit cost. And I also mentioned that marginal costing technique is an accounting system whereby the period cost or the fixed cost incurred are written off fully from the aggregate contribution. Not only that, the primary purpose or the primary feature of marginal costing is that is a concept that is designed principally to aid managerial decision. When it comes to decision making, you need the knowledge of marginal costing technique. Okay, then of course, and I mentioned the key points or the features that you need to take into consideration when you are preparing the income statements using the marginal costing approach. The first point that we discussed was that opening and closing stocks are valued at total variable cost per unit. You add up all the direct costs like direct material, direct labor, direct expenses, and variable overhead. You add all of them together, then you use it to multiply the opening stock in units. That will give you the total opening stock in value. Then, of course, I also mentioned that using marginal costing approach, fixed production overhead is not part of production cost. Rather, it should be written off fully from the aggregate contribution. The number 3 point I mentioned to you was that using marginal costing approach, fixed production overhead is a cost that has no sympathy for activity level, meaning that irrespective of level of unit produced, the fixed production overhead will not change because it is based on the budgeted output. It is based on budgeted or normal capacity level, so it will never change. Year 1, year 2, or month 1, month 2, month 3, whatever, it will not change until your budgeted output or your normal capacity increases. If your budgeted output still remain the same, then your fixed cost will also remain the same. Okay, the number 4 point we mentioned was that marginal costing approach does not consider overhead absorption. Okay, it doesn't consider overhead absorption. Okay, then the last point we talked about was that marginal costing approach considers contribution, unlike absorption costing, which recognizes the gross profit. Those are the 5 points I mentioned to you under marginal costing approach. Then we now proceed to explaining the absorption costing method. I gave you the format. I also explained the format. Then we now talk about the absorption costing method. We said that absorption costing method is a concept that charge the total cost of production, including direct material, direct labor, direct expenses, variable overhead, and fixed production overhead to the unit cost of a product. And I also mentioned that absorption costing method is a concept that relies heavily on the generally accepted accounting principle for external reporting purposes. Okay, so that was the introduction under absorption costing. And now we now discussed the key point or the future, specific features you must consider when you are presenting your income statements using absorption costing method. One point that we discussed was that opening and closing stocks are valued at total cost per unit. That is, you add up all the direct material, direct labor, direct expenses, variable overhead, and fixed overhead. You add all the 5 line items together. If you have them present in the question, you add them, then you multiply with the opening or closing stock to get the total value. Then the second point was that using marginal costing approach, fixed production overhead is part of, using absorption costing approach, fixed production overhead is part of production cost, and it will vary depending on the activity level. Even though it is called fixed production overhead, but using absorption costing approach, it will vary depending on the activity level. This is what I'm trying to say. Say, for example, we have year 1, year 2, then year 3. The activity level, say for year 1 is 1,000. The number of units in year 2 is 15. Number of units in year 3 is 12. Say, for example, the fixed overhead absorption rate is equal to 3 naira. The fixed cost per unit is 3 naira. Therefore, if I want to determine my fixed production overhead, I will say 3 naira, because your fixed production overhead is the actual unit produced multiplied by the fixed overhead absorption rate. So I've just said 1,000 units multiplied by 3 naira. That will give us 3,000 naira. 3 naira multiplied by 1,5 will give us 4,500. 3 naira multiplied by 1,2 will give us 3,600. You can see that the fixed production overhead is changing as the activity level is changing. So using absorption costing approach, fixed production overhead is part of production cost, and it will vary depending on the activity level. Okay, that is the second point we discussed. And the third point was that fixed absorption costing approach considered overhead costing. Okay, consider overhead absorptions, whether your overhead is under or over. So absorbed. So using absorption costing, you consider over absorption. All right, overhead absorption rather. Then the fourth point was that, okay, using absorption costing approach, absorption costing approach recognizes gross profits, unlike marginal costing, which uses or considered contribution. So those are the 4 points we talked about under absorption costing. And I think we had an illustration. Let me confirm. Let me check from the last material I shared with you. Just so done. Let me see. Just 1 minute, please. I want to confirm where we stopped last time. I want to know whether we solved any question. I think we did, but let me confirm. For me. Yes, we solved, okay, I remember now. We solved a question under, we solved this Fernandez question. And I told you that, okay, let's stop there so that others that are here to join the class, they can benefit. Okay, I remember now. Okay, so we now solve the question. This is the format. Of course, I don't want to go into that. I've already talked about it. So we solved the question on Fernandez. Illustration number 2. This illustration number 2 was what we solved. Okay, so let's have one more illustration, and we stopped. That will be the end of operating statement. We now move to relevant costing. So quickly, I need somebody to read for us. I need somebody to read the question on the illustration number 3, Panama Limited. Who will take the lead?
Panama Limited.
Thank you, Grace. Go ahead.
Panama Limited. Okay. Panama Limited makes and sells one product, which has the following standard production costs. The below data is assumed to be correct. Normal output is 16,000 units per annum. Variable selling, distribution, and administration costs are 20% of sales value. Fixed selling, distribution, and administration costs are 180,000 per annum. There are no units in finished goods inventory on 1st October 2021. The the fixed overhead expenditure is spread evenly throughout the year. The selling price per unit is 140 naira. Production and sales budgets are shown in the tables below and is said to be correct also. Required: prepare operating statements for each of the 6 monthly periods using A. Marginal costing technique, B. Assumption costing technique.
Thank you very much, Grace. That is the question. That is the question. The examiner wants you to prepare the operating statement using marginal costing technique. So we don't need uh, to waste too much time on this. It's important. This question looks very simple, but it can be dicey if you don't pay particular attention to the dictate of the question. You are expected to take some, to make some adjustments to some of the costs or information given in the question. But if you are too eager to solve it without considering those selling points, then you may miss the valuable points. Okay, so if that is the case, let me stop sharing this and move to the working notes. So quickly we can solve it. Let me know if you can see my working note, please.
Yes, sir, it's visible.
Okay then. So the name of the company is Panama Limited. Examiner is asking us to prepare operating statements using marginal costing technique and absorption costing technique. Number A, operating statements using marginal costing technique. Please, I beg of you, on the day of your exam, don't go to the exam hall and be using MCT. Examiner will penalize you. You have to write it out in full, at least for the first instance. Operating statements using marginal costing technique in brackets MCT, so that going forward you are going to be referencing MCT. But if you write it the way I wrote it on the screen, it means that you are you are putting yourself on the express. Examiner may deduct your mark because acronyms like this is not permitted without first explaining what you mean by that number, by that acronyms. Okay then. Yes, we have two periods. Period ending March and the period 6 months ending September. So let's outline our table. The first period here is March. Then we have period ending September. So we are going to restrict our number to thousands. That will save time on the day of the exam instead of write everything in full. Then I need to, for each period we have a debit, sorry, each period we have a debit and also a credit side. Therefore, we are starting from sales value. Let's determine sales. Everybody open to the material. You are going to be giving me numbers because I want you all to participate. For you to get the sales value, you are going to multiply units sold with the selling price per unit. In the question, selling price per unit is 140 naira. So what is the unit sold? In March, what is the unit sold? Yes. In the month of March, what is the unit sold?
140,000 and 140 naira times 7,000.
140 naira multiplied by 7,000 units I mean 7,000 is the unit sold multiplied by 140 naira. So what do you get?
980,000.
980,000. So this means that for the period ending March, 980,000, remember our figures are in thousand. 918,000 is the total sales. So immediately after, let's do March first before we do production, before we do September. Yes, Temitope, talk to me. What's your question?
Yes, I've been looking at the material, trying to find the 140,000. I
Is
can't see
there?
it anywhere.
Is there? Before the table, you see 140, the statement before the table.
Oh, yes. Thank you, sir. I've seen it.
You're welcome. Sorry, just give me 1 minute. Sorry for the break in transmission. Let's move on. Let's continue. So, yes, let's determine production costs now. Immediately after sales, you need to consider production costs. Remember, I told you last time, as far as operating statement is concerned, your starting point is to memorize the format. Once you understand the formats of both marginal and absorption costing, then of course you are good to go to solve any question. No matter how big is the question, you are good to go. All right. So under the production cost, the first item will be the opening stock. Yes, Temitope, you are raising hand. What's the
Yes, sir. You
question?
said we will have debits and credits, and
Yes,
for sales now, we haven't differentiated where we're writing it.
no worries. You'll be seeing it now.
Okay, sir.
So immediately after the production cost, the first item will be opening stock. Remember, we are using marginal costing technique. Therefore, this opening stock will be valued at total variable cost per unit. Therefore, we need to go back to the question. We add up all the variable costs. In the question, we have direct material to be 18 naira, isn't it? We have direct labor is 18 naira. Direct material is 28 naira. Variable production overhead is 3 naira. When you add up those three line items together, that will give us 49. That's 49 naira, meaning that variable cost per unit, total variable cost per unit is 49 naira. So here will be 49. So I will then go to the period ending March. What is the actual unit produced? Please, you have to respond to me as quickly as possible.
8,500.
8,500 units were produced for the period ending March. Therefore, 8,500 multiplied, sorry, we want to determine opening stock first. Let me see, what did I even write there? Sorry, yes. So you go to the question, go and pick opening stock in units. You can see in this question, we are not given opening stock for the period ending March. So we are not given any opening stock. So that one will be 0. So just put dash. Here will be dash. Then the next item will then be direct labor. According to the question, direct labor is what's direct labor cost? 18 naira. So direct labor is 18 naira.
18.
You also have direct material to be 28 naira. We have variable overhead, variable production overhead to be
3
3
naira.
naira. Okay. Therefore, in March, the actual unit produced in March was 8,500.
500.
So 8,500 multiplied by 18 naira. What do you get for direct labor? Yes.
153,000.
153. So here is 153. You write it on the debit side. 20 for direct labor, direct material cost. 28 naira multiplied by 85. What do you get?
238,000.
238. 238. 3 naira multiplied by 8,500.
25,500.
25.5. So add everything together. What do you get? Yes.
153. 416.50.
416.5. 416.5. This is called cost of goods available for sales. That is COGAS. Immediately after the cost of goods available for sales, you need to consider closing stock. So we need to go and value our closing stock. So this page will be for marginal costing technique. The second page will be for absorption costing technique. The third page will be for reconciliation statements. Then the fourth page will be for workings, because you don't mix workings with the main solution. Your workings should come last. Working number 1, we want to determine closing stock. So closing stock for the period ending March, period ending September. So when you want to determine closing stock, it's a format. The first thing you are going to do is to take the opening stock in units. The opening stock in units for the period ending March is 0. We don't have any. So you are going to add actual units produced for the period. Add actual units produced. Let me shift this one to the front. March, September, dash. So what's the actual unit produced in March? 8,500. 8,500. Add it to 0. That's 8,500. This represents total units available. It is from this total units available that the company will make sales. So you need to less the units sold. Less units sold. For the period ending March, how many units were sold?
7,000.
7,000. Okay, what's the hiatus?
1,500.
1,500. So this is the closing stock or unsold stock. Closing stock in units. So now let's value it. Before that, let's do September once and for all. Now, we are moving to the period ending September. The opening stock in September will be equal to 1,500. The closing stock in March, as we are moving to 1st April of the period, as we are moving to 1st April, the closing stock in March will become opening stock in April. So here will be 1,500. Then what's the actual unit produced in September?
7,000.
7,000 units. So add it to 8,500. How many units were sold?
8,000.
8,000.
8,000 units were sold. The difference is 500.
500.
So closing stock for the period ending September in units is 500. Therefore, let's value it. I would then say valuation. Of course, the valuation will be the closing stock in units multiplied by the cost per unit. Okay, cost per unit, total variable cost per unit, total cost per unit, depending on the method you want to use. So for the period ending March, under marginal costing technique, our closing stock will be equal to the units of 1,500 units multiply. Remember, we said that using marginal costing technique, opening and closing stocks are valued at total variable cost per unit. So what is the total variable cost per unit? 49 naira. Okay, 49 naira. So our figures are in thousands. Give it to me. What do you have there?
73.5.
73.5. That is for MCT for the period ending March. Then for ACT, absorption costing technique, still the same 1,500 units. Multiply by, what is the total? Remember, when you are using absorption costing technique, opening and closing stocks are valued at total cost per unit. So total cost per unit is what? 69 area. So 69 multiplied by 15. What do you get?
103.5.
103.5. Not the FMO. Now, we move to September. Let's do everything once and for all. For September, MCT, then ACT. Under MCT, closing stock in September is 500 units.
Yes, sir.
Multiply by 49 naira. What do you have there?
24.5.
24.5. For ACT, 500 multiplied by 69 naira. What do you get?
34.5.
34.5. So we are done. We have valued our opening and closing, our closing stock using the two techniques. So let's go and post. So we are still under marginal costing technique. For the period ending March, closing stock is 73.5. So let's go and post it. 73.5. So I would then come here. Closing stock is working number 1. Here is 73.5. What's the actual? What's the difference? Yes. What's the difference?
343.
343. This 343 is called cost of goods sold. Immediately after the cost of goods sold, before you determine your contribution, immediately after the cost of goods sold, you must consider variable non-production costs. There are some costs that are variable in nature, but not related to production. Okay, like selling expenses, variable selling expenses. It's not related to production, but it varies. The more sales you're able to generate, the more sales commission you are going to earn or the company will pay. So that is that. So I would then we'll go back to the question. Are we given any selling expenses? Is there any selling expenses in the question?
Yes.
So
20%.
what are they? So variable selling, distribution, and admin costs are 20% of sales value. So I will then come here. Like I said, you are going to add variable non-production costs. Variable non-production costs. So we have variable selling. Is there any distribution? Yes, variable selling, distribution, and admin at 20% of sales value. It's not based on unit, it's based on sales value. For the period ending March, sales value is 980,000. So what's 20% of 980?
196.
196. 196. There is no other variable cost in the question again. If you have any other variable cost, so you had it, but we don't have any again. So add it to cost of goods sold now. What do you have? That's
39.
539. So this 539 is less from the sales value. When you less from 980, what do you have there?
441.
441.
441. 441. This 441, what it is called? What's it called?
Contribution.
Profit before
Contribution.
tax.
No, it's contribution. Here is contribution. Remember what I said. So marginal costing technique recognizes contribution, unlike absorption costing that recognizes gross profit. So immediately after the contribution, you must deduct period cost. And that is why in the definition I mentioned to you that marginal costing technique is an accounting system whereby the period cost or fixed costs incurred are written off fully from the aggregate contribution. This is the aggregate, this is the total contribution. So immediately after contribution, you must deduct period cost. So I will then come here, period cost. Period costs are those costs that are fixed in nature. It could be on a monthly basis, okay? But provided the costs are fixed, put it under the period cost. So I would then, the first item you should consider here would be the fixed production overhead. Fixed production overhead. Remember what I told you when I was explaining the key feature of marginal costing technique. I said under marginal costing technique, the fixed production overhead is not part of production cost. Rather, it should be written off fully from the aggregate contribution. That is one. Then I also mentioned that the fixed production overhead is based on budget, will remain constant for the foreseeable future because it is based on the budgeted output. So when you want to determine fixed production overhead under marginal costing approach, it should be based on the budgeted output, not on actual unit produced. So I will then go to the question, what is the budgeted output? Let's go and do working for fixed production overhead if you want to, but on the day of your exam, you may not likely do working for that. Just carry your calculator and do what you need to do. Move on. No time to waste. So fixed production overhead. We said fixed production overhead, FPO. Fixed production overhead is computed as budgeted output or normal capacity level multiplied by fixed overhead absorption rate. The fixed overhead absorption rate is your fixed cost per unit. Therefore, of course, this fixed production overhead is under marginal costing technique. Okay, the fixed production overhead you are going to use under marginal costing technique is one we are calculating. Okay, therefore, the fixed production overhead is equal to, what is the budgeted output in the question? What's the budgeted output in the question? Yes.
8,500.
Pardon? Budgeted output.
8,500.
You are told, no?
16,000.
16,000. You are told in the question that normal output is 16,000 units per annum. Your normal output is your budgeted output or normal capacity level. So it is given as 16,000 units per annum. So you cannot use 16,000 units for period ending March alone or period ending September. No, because the 16,000 is meant for 1 year. Period ending March, period 6 months ending ended March is 6 months. Period ending September is also 6 months. Therefore, the total normal output is 16,000 units. Okay, multiply by period ending March and September is for 6 months. So multiply by 6 divided by 12 months. Are we together?
Yes, sir.
Yes,
So
sir.
that will give me 8,000 for the period ending. Budgeted output will be 8,000 for the period ending March, 8,000 for the period ending September. Then I will multiply with the fixed overhead absorption rate of how much? 20 naira. Okay, so what do you have here? If I like, I can say this is equal to 8,000 units. But again, you don't have time on the day of your exam. Just do what you need to do and move on. You don't need to be doing all this step one, step two. Just get the final answer and move on. No time. So the final answer here is 160,000. Okay. So the fixed production overhead under marginal costing technique is 160,000 naira for March, 160,000 for September. So let's go and post. Working number 2. Here is 160,000 in September, in March. Then we go back to the question, any other fixed cost you have there? We also have fixed selling, distribution, and admin. How much is it?
180,000 per annum.
Okay, fixed selling, distribution, and admin. We are told it's 180,000 per annum. So that's what I said, you have to be very careful. Because you are eager, oh, this question is very straightforward, simple. You are just rushing it without considering the dictate of the question. Remember, your fixed selling, distribution, and admin cost of 180,000 is per annum. You can't use the entire 180 for the period ending March or September. You have to divide it by 2. So let's go and do working for that. Again, no need working on the day of your exam. Just divide it by 2. Move on. No time. Fixed selling, distribution, and admin costs. We are told it is 180,000 naira multiplied by 6 months divided by 12 months, because the entire 180,000 is meant for 12 months. So period ending March and September, that's 6 months. So this one will give us 90,000 naira. That's it. 90,000 naira. Let's go and post it. So here is 90. Any other fixed cost in the question? None. So add it up. Here will be 250. 250 minus 441. What do you get?
191.
191. This 191 is called profit before tax. This is profits before tax. In the question, are we given tax rates?
No.
Are we given tax rates, company income tax?
No.
So if you are not given income tax, you are not given tax rates, then the profit before tax is the same thing as net profit. That will be the same thing as net profit, and that's where we stop in March. So let's go to September. In September, how many units were sold?
8,000.
Multiply by 140 naira per unit.
1,120,000.
1,120,000. Put it on the credit side. 1,120,000. That's the total sales in September. Okay. Now, production cost. Opening stock in September. The closing stock on the 1st of April. On the 1st of April will be 73.5, because the closing stock in March will be the opening stock in the September. So here will be 73.5. Okay. Then how many units were produced in September?
7,000.
7,000.
So 7,000 multiplied by 18 naira.
126,000.
126. 28 naira multiplied by 7,000.
196.
196. 3 multiplied by 7,000. That's
21,000.
21. So
21.
add it up.
$416.5.
416.5. It's just by coincidence that the two periods are equal. The cogas of the two periods are equal. It's by coincidence. Okay, so the next thing we need to do is to less closing stock. We have computed closing stock. So what's the closing stock in September under MCT?
5.
500.
24.5.
24.5. So what's the hiatus? What's the difference?
392.
392. Then you had variable non-production cost. What's 20% of 1120? Our sales is
Sorry,
1 million.
sir.
Yes. Talk to me. What's your question?
Oh, don't worry. Sorry, sir. I've gotten it. I was looking for the video. Thank you. No
Okay.
worries, sir. Thank you.
So what's 20% of 1120? Sales.
224.
224. So here will be 224. 224 plus 392.
616.
616. 616 minus 1120.
504.
504. Here is 504. That's the contribution for the period ending September. Then with less period cost, remember what I told you. As far as marginal costing technique is concerned, the fixed production overhead is a cost that has no sympathy for activity level. Irrespective of number of units produced, it will not change. It's the same amount. So here will be 160. It will not change. Then fixed selling, distribution, and admin is the same thing as 90. It will also not change. It's a fixed cost. Here will be 250. 250 minus 504 will give us a
254.
254. So that's that. That's the net profit for the period ending September. So this is how to present income statement using marginal costing approach. So let's go to absorption costing approach. Number B, operating statements. Using absorption costing technique. Our figures are in thousands. Okay, so here is March, September. Sales value for the period ending March is the same thing as under marginal, which is 980. Okay, then production cost. So under the production cost, you consider opening stock. Because we are not given any opening stock for the period for March, so put dash, nothing will be there. Then we consider direct labor. For direct labor, the same amount you have up there is what we are going to use. It's not changing. So 153, 238. Here is 153, 238. This is direct material. Then we have variable production overhead to be 25.5. Remember, we are using absorption costing technique. Under absorption costing technique, fixed production overhead is part of production cost. Therefore, I will then come here, fixed production overhead. The fixed production overhead is 20 naira. Okay, it's 20 naira per unit. That's your fixed overhead absorption rate. Therefore, in September, we produced 8,500 units. Therefore, 20 multiplied by 8,500 units. What do you get?
170.
170. So add up everything. Add it up. What do you have?
5.5.
5 what?
86.5. 5.65.
586.5. That's COGAS. Less closing stock. We've already calculated workings for closing stock. What do you have there? Under ACT.
103.5.
103.5. So give me the difference.
483.
483. 483. This is called cost of goods sold. In my explanation to you last week, my explanation of overhead absorption costing, let me repeat it again. I said that overhead absorption costing is the process of allocating indirect costs or overheads to a product or service. The indirect costs include rents, depreciation of machinery or depreciation of assets. We have electricity, we have utility, we have any other expenses that will be incurred in the factory that you cannot trace to any particular activity or product. Those are what we call overheads. Okay, so the process of allocating those overheads to a product or service is what is called overhead absorption costing. So when the budgeted overhead is the same thing as actual overhead incurred, it means that the overhead is appropriately absorbed. However, it is possible that the budgeted overhead will be different from the actual overhead. When this happens, the difference should be adjusted from the cost of goods sold. So at all time, when you are using absorption costing method, the overhead absorption should be adjusted from cost of goods sold. And I explained further to say we have under, overhead can be under, it could be over. I said that when budgeted output or budgeted overhead is greater than the actual overhead, it is called over absorption. If it is over absorption, the difference should be added to the cost of goods sold. But when the budgeted overhead or budgeted output is less than the actual overhead or output, it is called under absorption. If it is under absorption, it should be deducted from cost of goods sold. Irrespective, provided the budgeted overhead or output is not the same thing as actual overhead or output, it should be adjusted from cost of goods sold. So in this case, the next thing we are going to do is to go and determine, we need to go and calculate workings for overhead absorption. So you can't just come in and put any one of them. You need to do your working first. Whatever you have in your working will represent what you are going to put there. So let's go and do working for that. Working number 4 now. So I will then come here, number 4, overhead absorption. So for the period ending March, period ending September. So you're starting from the budgeted. In this case, it is budgeted output. So for the period ending March, what is the budgeted output?
8,000.
Thank you. That means you are following. It's 8,000 because examiner has told you that normal output is 16,000. No be so?
Yes, sir.
is 16,000 units per annum. So period ending March is 6 months out of 12 months. So that means it's 8,000 for period ending March, 8,000 for period ending September. So I will come here, budgeted output is 8,000 units. Here is also 8,000 units. So I will compare this with actual unit produced, actual output. So for the period ending March, we produced 8,500 units. Period ending September, we produced how many
7,000.
units? 7,000. So here is minus 500. Here is 1,000. And I told you that it will be over. Of course, this is what we call, this is the difference in units. That's the difference in units. So you need to determine the overheads. You need to determine the total overhead absorbed. Overhead absorbed. So, and I'll say that when budgeted output is greater than actual output, it is called over absorption. But when the budgeted output is less than the actual output, it is under absorption. So you can see in this case, for the first one, for the period ending March, because budgeted output is less than actual output, that means it is under. Once the difference is negative, that means it is under. If it is under, the difference of 500 units, you multiply with the fixed overhead absorption rate. And the fixed overhead absorption rate is 20 naira. So what do you have there? That gives us 10,000 naira. This is 10,000 naira negative.
Minus 10,000.
Yes, that's minus 10,000. For the period ending September, because budgeted output is greater than actual output, it is over absorption. If it is over absorption, then you are supposed to add. This one, you are going to less. In fact, it's even showing negative for it, so I don't need to put less. So multiply by 20. So here is 20,000. So let's go and put it there. So I will then come here under, let me use this normal thing I did in the formats. So we started with over or under. So for the period ending March, it is under. Under is 10,000. So you less. What's the difference?
473.
473. So 473 minus 980, what you get?
507.
507. So 507. Okay.
Sir.
This is called
Hello, sir.
Gross profit. When you want to talk, raise hand. So yeah, go ahead.
Where will I do that? Okay,
Go ahead.
fine.
What's your question?
Okay, I'm a bit confused about this under and over
Okay.
absorption, and whether to plus it or minus it, because this is just my thinking that if the actual production, the projected production was 8,000 and we
Yeah.
actually produced 8,500 and we
Yeah.
absorbed that rate, that means we've charged more expense to that.
Mm-hmm.
Okay, so that means you have to less it.
No. Your budget is your basis of your expenses. Okay.
Okay.
Now, excuse me. What we are saying here is that your budget is your basis of your expenses. Now, if your budgeted output is less than the actual output, You can't go above your budget. We don't want to go above our budget, isn't it?
Yes.
So your budget is 8,000. You end up spending more than your budget. The difference, you have to be at par with your budget. So that's why the difference is deducted from the cost of goods sold. Oliver,
Okay, yeah, I understand. Okay. Okay.
so I would then come here. Yes. After gross profits, the next thing you are going to consider is non-production cost, all other costs that is not related to production. So you are going to consider that. Here will be non-production cost, whether it is variable or fixed, provided it's not related to production, put it there. In the question, we have variable, selling, distribution, and admin cost. So according to the question, variable selling distribution cost that we had under marginal is 196 naira. You remember 20% of sales value of 980, that's 196, isn't it?
Yes,
Mm.
sir.
So you come here is the same thing, that's 90. You also have fixed selling, distribution, and admin. So here fixed selling, distribution, and admin. How much was that? I think
Think we
it
need
was,
to stop.
yes, 90,000.
You make
Fixed selling, distribution, and admin is 90,000. So here will be 90. No, sorry, this one
The
is
variable is
90.
not 90.
This one is
Yes.
196.
That's
yes.
Okay, so add everything together. That's 286. 286. So 286 minus 507, what you get?
2, 2, 1, 1.
221.
2, 2, 1.
220, 221. Okay, so this is called net profit. Since there is no tax in the question, so this is net profit or profit before tax. So you close, then go to September. Under September, our sales value is 1120. Okay, production cost, opening stock for the period September is closing stock of March, which is 103.5. Here will be 103.5. Then direct labor is the same thing as you have under marginal. What is direct labor there? 126,
196.
126. The second one is 196. Then variable production overhead is what?
21.
21. Here is 21. Then how many units were produced in September?
7,000.
7,000 multiplied by 20 naira. That's 140. 140. So add it up.
586.5.
586.5. Okay. Then closing stock. We have done closing stock before, which is 24. Is it 24 or 34? I think it's
34.5.
34.
Yes, sir.
34.5. So what's the hiatus? What's the difference?
552.
552. 552. Then we need to consider under absorption.
Is
We need
over.
to consider over absorption for September, which is 20,000, isn't it?
Yes.
Yes,
You
sir.
had it. Yes, you had it. The difference, I mean, the total is
572.
572. 572 minus 1120. What you get?
548.
548. Then we consider non-production cost. So what's variable non-production cost in September? That's 224, right? 20% of 112, 2120, that's 224. Here
Yes.
is 224. Then fixed selling, distribution, and admin in September is still the same thing as 90. Add the two together, that's 314. 314 minus 548, what you get?
234.
234. 234 is the net profit or profit before tax. That's it. But this is not sufficient. If you do it like this and you submit your question, your answer booklet, you are good, but you are not sure whether what you have done is correct or not until you prepare your reconciliation statement. In the question, examiner did not ask you to present your reconciliation statement, but it's important that you do it so that you know for sure that if difference in profits is the same thing as difference in stock valuation, it means what you have done is correct. So quickly, let's determine the reconciliation statement. Reconciliation statement, okay. Okay. So for the period ending March, September. So remember what I told you, you have to start with, of course, our figures are in thousands. So you have to start with profit before tax, not net profits in case. But in this question, net profit and profit before tax is the same thing since we don't have tax, we don't have income tax. But where you have income tax, it has to be profit before tax, not net profit. So I will then go to the question and pick profit before tax under ACT, profit before tax under MCT. Give it to me from the question. In March, what is the profit before tax for ACT? That's 221, right?
Yes, sir.
221, 234. Here is 221. Debit and credit. Here is 221. Here is 234. Then for MCT, what's profit before tax? Under MCT, 191254.
Yes, 191.
191254. What's the hiatus? What's the difference? Here is 30, right?
30, yeah.
Then this one is what?
So
Minus 20.
20.
Minus 20. This represents difference in profits. A. Then you now do stock valuation. Difference in stock valuation. Under the stock valuation, you start from closing stock. You need to determine difference in closing stock. Under ACT, then MCT. So in March, what is the closing stock for ACT? Yes.
103.
103.5.
103.5. Here is 103.5. Please, 1 minute. Yes, let's go ahead. Under MCT, what is the closing stock?
73.5.
73.5. So what's the difference?
30.
30 is the difference. Okay. Then you find you are going to less difference in opening stock.
That's 10.
ACT MCT. What's opening stock under ACT?
Zero.
Zero.
Zero. What's opening stock under MCT?
103.5.
Zero minus 0 is 0.
Zero.
So 0 minus 30 will give us 30. So this is
30.
difference in stock. B. Remember what I told you. At all time, when you are doing your reconciliation statement, A must be equal to B. Okay. Then we move to September. In September, what is the stock valuation? Closing stock in September is what?
34.5.
34.5. Here is 34.5. Under MCT, what do you have?
24.5. 24.5.
24.5. What's the difference?
10. 10.
10 is the difference. So let's find difference in closing stock, sorry, in opening stock. The closing stock in March will become opening stock in September, isn't it?
Yes.
So
Yes.
here will be 103.5, then minus MCT 73.5, difference of 30, right?
Yes. Yes.
So 10 minus 30, what do you have there?
Minus
20.
20. So you will look, when you look at the two, difference in profit and difference in stock valuation, you will notice that they are equal, isn't it? Yes.
Yes.
So when you do it like this, once the two balance, then it means that what you have done is correct. So you are rest assured that at least you have secured 15 marks or 20 marks, depending on the marks award to the question. So this is how to prepare operating or income statements using marginal and absorption costing. So this is the end of the class under operating statement. So we are moving to the second topic. Let me know if you have any question for me. If there's no other question, then I will stop sharing this. We move to a brand new topic. So let me give you 1 minute to digest that. 1 minute. So let me stop sharing this. And I will stop.